Hello everyone, welcome to another session on dollar INR. But today, before I come to dollar INR, I want to have a look at the Brent crude oil price, and then we'll come to dollar INR, and then we'll come to the hedging decisions. Okay, so first, this is the Brent crude. This is, remember, a 4-hourly chart. Okay, so it's a 4-hourly chart. Let me get my pen. So if you look at it, after all the peace talks, we have seen a small bit of a decline in crude. Okay, earlier it declined further, then it went higher, and now it has declined a bit. Okay, but not a big decline. It is still trading in excess of $92, $93 per barrel, and that is not a comfort position or comfortable point for India as well as for the globe. Okay, so crude is cooling off, but not cooled off to create decent amount of comfort for dollar INR. Okay, so that's on crude. Let me come back to the dollar INR. Okay, so this is the dollar INR chart. We have been following this very closely, a very classical uptrend that we are following. But what has been interesting is the action that has happened today. Okay, so dollar INR closed at 95.79 yesterday, opened at 95.71, but today it substantially recovered. The rupee recovered and closed below 95 level. It closed at 94.95 levels. Okay, so in excess of 84-85 paisa recovery in the rupee today compared to the previous close. Okay, if you look at this candle, a really long downward black candle, red candle, a negative day for dollar and a positive day for rupee. So quite a significant gain that we have seen in the dollar INR as of today. Okay, now what do I do? Here, if you look at the chart, I want you all to look at two sets of moving averages. Okay, let me first clean this up. Okay, look at this blue line and the yellow line. The blue line is the 25-day moving average, and the yellow line is a half percentage filter below the 25-day moving average. Okay, so this two will move in tandem. It's just a percentage filter below the 25-day moving average. And if you see the chart carefully, multiple places this moving average and its filter has given support indications. Okay, the entire region, this region again, this region twice, and then again just a few days back, and currently the price has again come to that region between 25-day moving average and its half percentage filter. Okay, so this is some indication that the dollar INR has come to a level where importers can start looking to hedge their positions as far as market timing goes from the 25-day moving average. Okay, I want to show you another one. Okay, so that is the 50-day moving average. Okay, so let me hide that. Okay, now if you look at the 50-day moving average, we have seen relatively far lesser attempts. Okay, the green line is the 50-day moving average, and the red dotted lines is the percentage filter below the 50-day moving average. Okay, so here if you see it, again very good support region here, support indicator here, very good support indicator here, but since February we haven't seen a 50-day moving average acting as some kind of a support. But again, in these two places it came very close to the 50-day moving average. So if you see the 50-day moving average, currently it's around the 94.50 level. Okay, if you see here, it is around 94.50 level. Okay, so what does this mean? This means that obviously the rupee has gained, RBI is taking a lot of action, Government of India is taking a lot of action, policy changes. What are the policy changes? Please follow our research community. You will be able to notice big changes that the Government of India and the RBI is doing to help the rupee. So rupee might recover. We have seen a good recovery of rupee today. Now there is a possibility that the rupee might gain a bit more and reach this region of the 50-day moving average and its half percentage filter below the 50-day moving average, and that is typically coming around, if you see, 94 to 94.50 levels. Okay, another 1% lower in the dollar INR. Okay, so that is it on the dollar INR and all the market timing techniques. Now let me come to the option premiums. Okay, but before we come to this, let me tell you, the levels are approaching a comfort region for dollar importers. Okay, dollar importers have not got many chances. You would have seen in this chart, it is an uptrend. So exporters get more chances to hedge, importers get far fewer chances to hedge. Okay, so now looking at least a 25-day moving average, you should look to start hedging. Okay, and if it comes lower to 94, 94.50, you should certainly look to hedge aggressively. Okay, now let me come here. A dollar importer should typically look to hedge predominantly using forwards, because the forward premiums are quite less, and we have seen that the rupee weakening is on an average quite significant. So use forwards as the preferred instrument. But if you look at the option premiums, this is a simple chart which shows the 1 month, 2 month, 3 month and 4 month vanilla option premium cost for at the money options. Okay, so your strike prices are equal to the forward rate. So if I take a 1 month option, if I take a 2 month option, what would be the cost? And this is the trajectory that shows how the option premiums have changed in the last 1.5 to 2 months. Okay, so if you see beginning of the war period, the premiums had shot up, the cost had gone higher. Then war cooled off, the cost came lower, then it went up again because of another flare up. Now it has come lower again. Okay, so if you look at the vanilla option premiums, it's around 70 paisa for 1 month. Okay, and around 95 paisa for 2 months. So you are getting a protection of 1 month by paying 70 paisa and protection of 2 months by paying 95 paisa, and that is quite decent. Remember, yesterday to today itself, in one day we have seen rupee recovering by almost 84-85 paisa, and you are getting 1 month and 2 month protection with 70 and 94-95 paisa. Okay, so dollar importers should also look to do some kind of vanilla options to get some flexibility in case rupee recovers. Okay, so forwards predominantly and some degree of vanilla options. Okay, that is for dollar importers. Finally, what is there for dollar exporters? You know, if you look at this chart, I am sure all of you are following very closely. Dollar exporters have got multiple chances to hedge. So I don't think dollar exporters will be under hedged now. But if you are under hedged, then at this position, I would recommend using dollar puts rather than going for simple forwards. Okay, we are not out of the woods. Crude prices are still very high. Geopolitical risk is still very high, the high risk premium. But the government is trying to do something, so rupee might stabilize. But the pressure on rupee will remain till the time crude prices come down substantially. Okay, so dollar exporters, if you are under hedged, try to look to do some puts, not too many forwards. Probably forwards, resume forwards spot above 95.50, 95.60, but below 95 or close to 94, 94.50, don't do forwards, try and do dollar puts. Okay, so that is it from my side. Have a great evening and a great weekend ahead.